Brilliant. Good morning, everyone. So my name is Sam Hill, head of trading at Brook. So my team is responsible for the procurement of physical gas, physical power, and all the renewable certificate trading on the desk and for the business. So this morning, what we're going to talk about, it's not going to be a big market update. We send out a couple of those every day. So if you're not getting them, you should sign up to them. But otherwise, what we're really going to talk about is kind of back to basics a little bit on building a strategy and calling out some of the key bits that we often see either people missing or just changes like post-energy crisis and how to reframe the question. We'll go through some basics on contract types as well as some different strategies, how the current forward curves are looking, and some procurement sort of changes that we've seen in our customer base that you may want to consider or at least be aware of what's going on there. And then we'll talk a bit about renewable procurement all the way through all the way from REGOs through to PPAs as well, and just wrap up at the end on some conclusions from the whole lot. So hopefully you find this informative or helpful, and there might be times where some of this is a bit basic, and if so, apologies, and other times where hopefully you find something interesting. So what we'll do is we'll kick off on building a strategy. Thank you. So I guess there's four key sort of pillars that we see in terms of building a good procurement strategy. The first is really around risk appetite. So the next is then success definition, like what is a good job? The third, which is a bit of a cheat because it's a couple of things in one, is just ensuring you've got all the building blocks you need in order to be able to actually implement that hedging strategy and policy. And the last one, which is sometimes overlooked because everyone's busy day to day, is actually that review process. So if we start on the risk appetite side, I guess some good questions that we find to frame the discussion there is actually trying to identify, first of all, what is your energy risk? How much are you able to pass through of commodity, both volume and price risk, to end customers? How much of that is retained in the business? And even if you are passing it through to end customers, where's their pain point? At what point does this no longer become acceptable or interesting to wear that risk? Another one is just actually where does energy spend rank in the overall cost in the business? What happens if energy costs move by 10%? What does that do to not just budgets and whatnot, but actually the bottom line of the business? How does that change things? And then one of the other things to consider is actually just that trade-off between certainty and cost savings, both in terms of initial structures and contracts, but also on a day-to-day basis whilst you're hedging as well. So I think one of the other things there is in that second bullet point is just ensuring all key stakeholders are included outside of the procurement or the trading team, making sure that ultimately when you come to the flexible hedging strategies we're going to talk about, some of those are actually very, very finance led, and making sure that they're on the same page and everyone's clear about how much risk is being taken in the business with regards to commodity is incredibly important, especially when things either not go wrong, but when things get super volatile like we have seen. The next thing there is just framing, like I said, what is a good job? What is success as part of that hedging strategy? We see basically there's kind of three main ways of looking at that. The first is budget, so looking at the variance between how much you expected to spend and how much you are spending on commodity costs. The other one is actually looking at the market and some market-based metrics, i.e. variance between what you're spending and a moving average through time, or how much you've spent on hedging versus what it would have been entirely at the spot, which isn't a perfect measure because unless you've got ability to pass that through, or unless you've got financial hedges, it may not be the best risk management strategy. But either way, sometimes it can tell you how good, as part of that review process, the underlying strategy was. And the last one, which is a bit more sometimes advanced but also a bit more complex, is really what we call risk-based metrics. So for example, agreeing a value at risk that you're willing to assign to any open position at a given time. I think really good outcomes of that definition piece is about finding that clear definition of success that everyone can agree on. Is it budget certainty? Is it cost minimalization at some more risk? Then agreement on those KPIs and benchmarks that feed that clear definition of success. And then finally, an agreement on reporting and how you're going to communicate that within the business and also to any external shareholders. The next piece is on those building blocks. This is again sort of pretty fundamental stuff, but it's ensuring that you've got what you need with regards to governance. So oftentimes people, and what we saw in the energy crisis especially, was when things did get really volatile, actually sometimes it was those governance sort of processes that were a bit more under strain than was expected. It's making sure everyone who's an authorized trader, who is actually able to approve any changes to the strategy. If things are going wrong, if the strategy is not being met, if the discipline isn't quite where it needs to be, what are those escalation points? how do you and when do you loop in the next level of decision making into the strategy. The next one is actually sometimes overlooked, really. It's volume forecasting. It's just making sure that you can effectively break down your volume into kind of that known portion, stuff that you know will turn up, and that bit that's a bit more variable, which is fine, but that can also that can feed into quite clearly how you decide to hedge that risk out. So being really, really clear on that, and any changes as the site is changing or any new contracts are rolling in, that's really important to be able to understand how that's going to move, especially depending on what type of product you're on, which we'll get to shortly. And that last bit, or one of the last bits, really is around access to market pricing information and just understanding what's going on in the wholesale market. That could be as simple as signing up to the Brook Green Supply, market updates. It could be ensuring you've got your own pricing platforms and ability to see the market, web screens. It could be signing up to Reuters, news aggregators to see how those headlines coming in and how that's moving the market at any given time. And then I think one of the other things is making sure that, if you've got a hedging policy that says you want to hedge out for 5 years, does your supply contracts actually align with that? Are you able to achieve and to meet that strategy goal? Ensuring that you've got everything documented and there's version controlling on some of these documents can be quite helpful as well. Something we saw a lot of customers move to over that energy crisis, again, as that governance process sort of got tested, was ensuring that there's actually sign off at various levels and that there's clear and concise documentation about what's going on the ground as the people facing the market on a day-to-day basis. That last piece as well is just on review. It's making sure that regularly, a certain audience to be defined by yourselves, but there's a regular sit down on actually how that strategy is doing, and not just the underlying strategy, but also that discipline to the strategy. One of the things that when we're sitting down as a desk on the trading side is making sure that, one, we've got a plan at all times, as you might expect, but two, that plan's being followed. And if it's not being followed, there needs to be a really clear reason why. Because one of the worst things you can have is a plan, not following it, and then that plan ultimately being the right choice. It hurts in all kinds of ways, and it's important to be able to maintain discipline to that. And if you feel that the discipline is not quite there and you're constantly breaching it, then that's the real time to kick on with reviewing the overall strategy, and is it just achieving what needs to be achieved for the business. Just staying on top of, again, market conditions there and understanding how that's moving and what changes to strategy might be needed are a really important part of that review process. So it's a bit of internal reflection, strategy reflection, and then sort of outward reflection on the market and has it changed. And some of those changes, I guess, we'll talk about quite shortly, actually, of things that are challenging the status quo that we've seen for the last, sort of 20 plus years in energy markets. What we'll do is we'll go over some of the contracting types that you can get with. I've used our product set, but it's broadly similar to be honest. You've got fully fixed prices, whereby as the name suggests, you've got the highest level of budget certainty. Day one, you're fixing out your entire commodity cost within an agreed tolerance. Maybe that could be 20% annual, or it could be volume tolerance removed completely. But this contract will give you that highest degree of simplicity, and also, generally speaking, comparability between different suppliers. Obviously, there are cons to this. It's not just upside from a fixed price agreement. What you are doing is effectively reducing and removing your optionality completely. You've got a single point of time where you're making a decision about your entire 12, 18 months spend of energy, at least with regards to rate. And you have no ability then to react to market conditions. If the market goes up, you've done well, but if it comes down, you've got no ability to change your approach at any given point. And also, for that level of certainty that you are getting, there are, of course, risk premiums. That risk doesn't disappear; it just sits in a different place, i.e., with the supplier. Then, when we talk about flexible products, here we call it choice and cash out. Choice is really around volume tolerance, and cash out is, as you might suggest, you've got the cash out exposure or the balancing risk, or some of the balancing risk. The key thing between both of those is that ability to trade in increments. So all of a sudden now you can start putting in tailored hedging strategies. You can start saying, what happens if the market does this, then I want to do X, as opposed to just, I want to be fully fixed. Within the flex choice or the volume tolerance piece, your shaping costs will be fixed on day one as well, or an annual period, depending on how you do it. But certainly those shaping costs will be fixed for an amount of time. And then the volume tolerance that you get afforded in that contract, as well as the ability to reforecast, which you don't have in a fixed price contract, will allow you to not only mitigate your price risk, but also your volume risk through time. Again, on the con side, you will be open to the market, and that's the same on both flexible agreements. On the VT side, again, where someone's fixing your shape, they are stepping into uncertainty and risk for you on your behalf, and ultimately end up needing to be paid a small premium to be doing that. Then on both sides, you do have some limitations of wholesale market liquidity and availability. So at a given time, if you want to hedge 1 to 28, there may or may not be a market for it. But that's not too dissimilar to fixed price, to be honest, where there may not be a willingness from suppliers to extend fixed price curves out that far. On the cash out side, one of the main differences is that there are no constraints on consumption. Whatever you consume, you'll be back billed to, and that does open you up to shaping costs, which may not be a pro, but it's also because there are benefits to that too, which we will come into in a few slides time actually. And for that, least amount or most amount of risk being borne by yourselves, that also leads to the lowest amount of risk premiums being applied by suppliers. So it can be the most cost effective from an initial procurement point of view, although there are obviously ongoing risks with being in that product. That requires a bit more hands-on active management, but can ultimately get you paid for doing that by lowering energy costs potentially. Then in terms of that flexible piece, that's kind of what we're going to focus on going forwards, because the fixed price is so vanilla. It is quite clear and obvious as to what that looks like, and it's the hedging strategy there is you've decided to do a fixed price. So from this point on, we'll talk a bit about the changes that you or the different types of strategies that we see people implementing on the flexible side. Generally speaking, there's kind of three main types, one of which is time-based, another one is budget-based, and then the last one, which may or may not be hedging. When I say that, I mean it may be more like trading than hedging, where you're not just trying to achieve a cost certainty or cost averaging through the market. You're actually actively taking decisions, would be that dynamic side. So on the time-based, what we see generally is the features would be something like a hedging ladder. So we see people saying, we want to be anywhere between 50 to 100% hedged in month plus one. By the time you get to quarter plus one, that might be 30 to 70, and then over time that ladder drops down and the hedge ratios drop down over time. The other one is just this regular hedging interviews. So for example, what we see, especially with people with specifically large portfolios that may struggle at times with market liquidity, is people coming in regular intervals. So hedging 1 meg, 2 meg, 3 meg, 5 meg every 1, 2, 3, 4, 5 weeks at certain times, or splitting up their volume pretty equally across a certain amount of trading periods. Now, what the point of this is really is about trying to avoid any risk of timing the market. Now, we talked about that on the fixed price side, where you may or may not get it right. If you fix at a certain point of time, the market can move either in your favor or against your favor. The point of this time base is to try and sort of avoid that and average into markets over a defined period of time, so that you don't get that decision wrong on a single day. You give yourself much more chance of getting in at good prices. Now, we see that really best for businesses that want to prioritize that consistency, simplicity. Again, it's not about having a view on the market. It's about having a strategy that you agree on and then implementing that very, very consistently through time. What that does lead to is a bit of a lack of flexibility. If you've got that, I need to hedge 1 meg every week or every day, you've got a lot less flexibility than being able to say, okay, well, over this week I need to do X, Y, and Z, but I could move that depending on what the market's doing. So if it's trending up, front load the week. If it's trending down, leave it to the back end of the week. Those types of things. If you're staying really, really true to that time-based method, it will be a little bit less flexible, but ultimately should give you, or avoid that risk of time in the market. The next one is budget-based, whereby we see customers setting a budget either a year ahead, 6 months ahead, 5 years ahead, whatever. And what they'll aim to do then is just hedge in the market whenever the market is at or below those budgeted prices. Now, there's a discussion about how you set that initial budget. Often we see that anchored to trailing averages of pricing over time to try and get people to say, okay, well, we think relatively this is a good or bad value. Obviously, you have something like an energy crisis, and that blows up a lot of those trailing averages and can make things a bit more tricky. But that's one way that we see people doing it. Another is literally, like this was the budget last year. We want to beat it. There are various ways of doing it, but often the underlying agreement there is that there's a budgeted number that you're trying to either meet or beat. We then see things like these tiered pricing triggers. So, for example, you've got 25% at the upper budget level of 90, and then as we move through move down through the market prices. We want to hedge further and further, 25%, then a 25%, then a 25% to average in at a good price. Now, that again, that's really best for those finance-led procurement teams. This was what we were talking about when we were talking about setting that initial strategy, is that some of these strategies are actually quite finance-led. It's all about budget at the end of the day and making sure that the spend on energy is in line with expectations. The limitations of that is that, if the budget is set wrong at the start, or actually you set it right and market conditions completely change, you can either end up with a big reliance on spot prices because actually the market doesn't fall below those numbers at any given point. And when that is the case, we either see people relying on spot markets perhaps too much, or the other thing is, when people are managing their risk a bit better, what they'll do is they'll set stop losses, where the idea is, okay, the budget's at say 100 pence. If it gets to 105 or 110 or 120, I'm going to lock in 25% no matter what. I'm just going to do it and get it done, so that we don't have this, unknown energy spend. And the last piece is just on dynamic. Like I said, that's almost more like trading really than hedging, and it's quite important to note the distinction there. The point here is all about optimizing that price paid. It's all about trying to get that as low as possible based on a genuine view on the market. So what we see there is people either delaying their hedging, accelerating their hedging based on if they're bullish or bearish price action, and then constantly what you have to do with that is ultimately, you're a mini trading desk really. You're all about actively monitoring what's going on in the market. Now, as you might imagine, this is not the best for everyone. It is highly involved, it's highly technical, and what we see really is that that's best fit for not that many businesses, to be blunt, but ones that do want to employ it and employ it well, with those with pretty high risk appetites, really sound risk management strategies, and ultimately effectively in-house trading teams. It's almost like a trading desk within a consumer. You do have like a high reliance on being right, and really feeling like you can understand what's going on in the market and own that. So that is by far the most complex and challenging of the strategy types that we see. But and it is fair to say as well, we do see a blend of some of these. It's not strictly time-based or strictly budget-based or even strictly dynamic. It's normally somewhere in between all of these, and you can get parts of that dynamic hedging strategy feeding into either of the other two. But those are kind of the three main buckets that we see employed on a day-to-day basis. What we'll talk about now is some of the stuff that we're actually seeing, I guess, on a day-to-day basis from the desk. This isn't a market update, as I said, but I think it is quite good to give some context about the procurement activities that we're seeing. We do see, as everyone does, this is the forward curve, but we see the gas and power markets in backwardation. So forward prices are cheaper than the spot or the front of the curve, and that's for a number of reasons, mostly around a massive amount of energy coming into the market on the gas side. Gas demand is expected to dwindle over time, both in terms of physical gas usage through the meter, but also gas for power demand too on the gas side. We've got this rapid build out of renewables, which is leading to that reduced gas for power demand. And also, they're zero marginal cost generators, so they should have the overall effect of reducing power at the highest level. We'll get into shaping in a minute, but certainly at the highest level, that is the expectation. And then a reduction in geopolitical tensions over time too. I don't think we can get, well, actually I shouldn't say it, but I don't think we get much worse than 2 wars going on at the same time, 3 for a while with India, Pakistan too, and the amount of tension that we are seeing on the geopolitical landscape, as well as a new president in the US. So what we're seeing in regards to people actually, making use of this backwardation is on the fixed price side. What they're seeing really, or what we're seeing is people trying to fix for longer periods to try and average in at much better prices, take advantage of that cheaper back end by averaging in, longer periods and dragging that front end down for an initial saving, kind of on day one. On the flex side, definitely what we're seeing is that people are looking to trade much longer durations than they were before. People were really quite happy chipping away at front month, maybe up to 3 years ahead. There seems to be actually better liquidity in the last sort of six or so months on both UK gas and power markets at the back end. And what we're seeing there is customers are wanting to trade longer durations in much higher hedge ratios than they were before. I think that comes down to 2 things. One of which is that people do have those budget setting or budget beating strategies. The way the curve's structured, you can already beat year 3. You can already beat year 2 budgets in year 3 just with the shape of the curve. So people are taking some risk off the table there. But the other piece is actually the back end sort of call it anywhere between 65 to 75 pound a megawatt hour for summer and winter power prices, and actually not too dissimilar on the gas side. They're not a million miles away from those long-term historic averages that we're all used to at 50p's, 50 pounds a megawatt hour either. So we're seeing much more engagement at the back end of the curve, and people fixing either through fixed price or flexible agreements for longer and in higher volumes on the flexible side. We'll talk a bit about shaping, and also not just shaping, actually just that general decision that has to be made in every hedging strategy, which is how much is going to be hedged forwards and how much is going to be left to the spot. Now, we see that as a really key part of any risk management strategy. And historically, people have been quite static on it. It's just a view that's put in at the start of a year, and it doesn't really move around too much. It's just, we're going to take 20%, 30%, 10% to the spot. That doesn't necessarily work all that well anymore. The market is definitely changing, and being more dynamic on that, either on a month-to-month basis or a seasonal basis, we see can actually yield some higher performance and squeezing a little bit more cost saving out of the strategy. So what we're seeing really is a bigger and bigger discount between the curve, how the curve prices on the power side and the prompt pricing, especially in summer delivery. So what you're seeing here is EPEX base loads, but also peak loads against where that front month expired on the last pricing day of the forward. So generally speaking, high level, what you've seen is that April and May so far, you've seen respectively a £7 and about £2.50 odd discount from where that expiry was to where the base loads, priced out in the prompt. But actually, for those customers with shaping exposures, i.e. on cash out, what has been really interesting and something that we've been keeping a big eye on the desk is actually that spread between the base load and the peaks. And you can see there at the far left of that graph at the start of it, and also, actually quite consistently throughout, all of a sudden those peak prices are actually pricing at a pretty decent discount to base. So what we've seen is that over April 25, all day peaks, i.e. including the weekends, but 7 days, 7 to 7 power prices, so 7 a.m. to 7 p.m. 4 days a week across April, were about £4.50 cheaper than the overall base load, and in May it was around £6.50. You've got some bank holidays in there in the May that drags that lower for sure, but ultimately you're seeing that consistently now, as soon as we have a little bit of wind on the grid, actually it's a bit dramatic, quite a lot of wind on the grid, plus a good amount of solar, that block 4, that solar peak, is getting smashed. Yeah, so those prices are coming off quite heavily. Now, what we see on the flip side is that winter, and actually going forwards as renewable rollout continues, we expect both of these things to almost get worse and worse, is that spot prices in winter peaks can get particularly scary. Obviously, we saw it in January where we had quadruple digit power prices on the system imbalance prices, and actually even at a day ahead stage it was not too scary, 250 plus, but big enough. What we're seeing is a real ability for power prices at the prompt in winter to be especially bullish, and in the summer that shape to almost be inversed and a bit cheaper. So what we see people doing is generally having much higher hedge ratios in winter months and much lower in summer. And before they were always kind of that way around, but we're seeing that sort of spread, i.e. the hedge ratios in summer come down quite a lot and the hedge ratios in winter come up quite a lot to where they have been historically. And again, for anyone with shaping exposure on cash outs, those peak prices, which were normally the scary part of the curve, they have been over summers for the last year and a bit actually relatively cheap versus the base load. So it can be good to leave some open position there to capitalize on that. Obviously, all depending on your risk appetite. Okay, we'll talk a bit about renewable procurement, where we'll start with REGOs, renewable electricity guarantees of origin. Historically, they were seen as a bit of a quick win. They can be used to reduce your scope 2 emissions to zero. Previously, they were very, very cheap and really thought of as a bit of an afterthought and not a massive part of anyone's commodity hedging policy. It was 10, 15, 20p, chuck it on the contract, don't worry about it, and focus on the big numbers of power at £50 a megawatt hour. That's still somewhat the case with regards to the change of things, but what we saw of the REGO market in the last 3 to 4 years is that this has got volatile. It's got really volatile and it swings around quite a lot. We saw massive price spikes when the UK no longer allowed the importation of GOs, guarantees of origin from Europe. And then from that, price spike, we saw the market shed a huge amount of demand. What we saw was INC customers, a lot of our customer base actually turn around and say, look, we're not going to buy this, it's too expensive. And we also saw a lot of the domestic suppliers pulling all their green tariffs where they're sat on price cap, and ultimately their margins are being hammered. So that really comes back to one of those key pieces that we see where I think everyone, well, not everyone, but people forget sometimes that the regos are optional. The main difference between a rego price and a power price is that you're going to have to consume through your meter in order to fulfill your business needs. The rego is an optional piece. I think that's what people forgot when it got to £25 a megawatt hour. The demand side, which was previously thought of as relatively inelastic, is incredibly elastic. People will step out of this market if it gets too expensive. So we've got big question marks about how much of that demand will return and actually can return. People have got very, very used to not buying this now. They see that the world still spins when you don't buy regos, and ultimately, we'll be interested to see kind of how that curve moves over time on the basis that demand is not necessarily going to be coming back from the traditional sources. What we are keeping a really big eye on is actually kind of what that looks like going forwards with new sources of demand, say for data centers, for example, EV networks, those sorts of things, and that general electrification of demand. One of the things that we have seen fall out of this massive volatility really is a completely different demand for new approaches. So we've seen demand for approaches that treat regos like the underlying power, i.e. like a commodity in our customer base, and we're really excited about that. We think it's really interesting. It kind of, it's that rego market growing up a bit and behaving more like a real market. We've supported customers on buying regos and then selling them back during this price journey. We've also helped people look at proportions of the demand instead of 100%, instead of a binary choice of buying or not buying. And we've also helped people bring in asset-backed regos and sleeve that into their supply agreements, and as well as like those that they purchase OTC and bring them into supply agreements. I think the key thing here is the rego market is changing. It's becoming more complex. It's becoming more interesting and actually something that you can optimize within your agreement in the same way as you would with the power price. We'll look at some of the ways in which people are doing that. We see on hedging strategies for regos is that the forward curve is actually in contango, so it's the opposite of the power market. The forward products are more expensive than the spot. That suggests that the balances are going to tighten. There must be demand coming from somewhere, because what we do see in that shaded area underneath is that the amount of renewables rolling into the scheme is massive. In CP23, we see 60-ish terawatt hours of renewables just coming from CFD assets, so that doesn't include merchant. By the time you get to CP28, that's doubled, or over doubled actually. It's like almost 130 terawatt hours a year. So it's a huge amount of volume that's coming to the market on these regos, and despite that, we see the curve more expensive at the back end, which the only thing that can solve that really is an increase of demand. But regardless of what's causing that, what we do see customers doing is bundling the front of the curve with the back end of the curve. Again, if they need to buy regos for the next couple of years, what they're trying to do is all in one strip so that they can use that cheaper front end of the curve to drag down the cost of the back end. And then those with a bit more risk appetite are actually saying, well, why don't we just buy the front end where it's a bit cheaper and we'll leave the back end because of this big rollout of renewables. We do also see quite a few clients actually now opting for biomass only, because you can see that price spread on there. They do price at a discount, and people see it as a way of achieving what they need to on scope 2, but at slightly reduced costs. We'll talk a bit about PPAs as well. It's something that the whole industry is focused on, but we certainly are as well. And we're just thinking about that integration piece, like how do you get this into your supply agreement? I think there's like six key things to look at. The first is just agreeing what structure and like what your intentions are with procuring a PPA. How much appetite of balance and risk do you have? Again, you'll be used to some of this from the same discussions on your power and gas hedging strategies. But again, that intentions piece on, say, something like additionality is important to you or not. Tenor, what is a good tenor for you? Previously, when we looked at PPAs, everyone was talking about 10-year, 15-year, 20-year agreements. That's not the case anymore. We do see generators willing to fix in for 6 months, for 12 months, for 24 months. Ultimately, from their side, they've seen the energy crisis in the same way that most of us have, which is that, but from the flip side, where ultimately, if they're selling out at £70 a megawatt hour or whatever, they've seen that prices can go up to £800 a megawatt hour for baseload. Whether or not we'll get back there is up for debate, but that new level of what if and optionality is something that they're looking to retain, and fixing over shorter tenors is far more reasonable now and more likely. The next is actually just looking at your consumption shape and saying, does this match with any given renewable? technology? Are we super basic? Does it suit an AD profile, an energy from waste profile? Actually, do we have a lot of demand during the solar peak? Okay, perfect. Let's use that. Let's try and match up that solar side. Again, building baskets as well of solar plus hydro, because they can be a bit of a natural hedge against each other. Thinking about those different technologies and how you can sort of basket them up to try and match your consumption shape will ultimately lead to lower shaping costs overall. Then the next piece is actually that you've done all that good work on setting up a hedging policy. Right now, how does the PPA interact with it? Is it going to mean that if you've got a 3-year horizon on your hedging policy and all of a sudden someone's showing you a 10-year PPA, do those things align? And if they do, how do you make those reconcile? It also might change the amount of volume that you need to take to the spot market, depending on what you need to leave open, depending on the PPA structure. So just changing that hedging policy around in order to fit the PPA that you're looking to procure is important. The next piece is your supply contract, making sure that that agreement actually allows you to integrate PPAs, and you're going to breach any terms, but can you just do it in the best way possible? And the last bit is sourcing. Once you've decided what PPA you want and how you want to do it, actually, do you have the ability to go out and find that? Have you got a team internally that will source that renewable generation? Do you need to work with a supplier or a partner in order to facilitate that? So those are some like high level thought pieces on what's important when you're going through that initial stage of do we want a PPA, and if we do, what does it need to look like, and what changes might we need to make to our day-to-day to facilitate that. We'll just talk about some of the delivery profiles of PPAs. What we see is there's 3 main ones: pairs produced, pairs forecast, balanced and shaped. We're not going to go into loads of detail, but really what we've got at the far left is quite a lot of balance and risk sat with the off-taker, which in this case would be yourselves if you're buying a PPA. And at the far right on the balance and the shape product, that's actually the least. That's where effectively what someone can do is make that PPA look more or less like a base load trade that you might do with your hedging desk on your flexible procurement strategy. That's a really good entry level PPA structure. We see that as a way of getting volumes into hedging strategies in quite a simple and clean way. But obviously that does also come with that same budget certainty we saw on the fixed price, and therefore higher risk premiums. Again, this is something to take away and read and have a bit of think about. And if there are any questions, either chuck them in the Q&A or reach out to us after, and we can go through any of these types and also talk about some of the pricing types, because this is just on the volume delivery in a lot more detail. What we do is just finish up with some conclusions. Again, if we think about high-level conclusions, some of the most important things to define really is that risk appetite. What is your risk as a business to commodity prices and to volumes, and then how much are you willing to wear of that, and how much of that do you want to ultimately sell to someone else? Then defining what a good job is and making sure that that definition is constantly updated as part of the review process is quite important. And reporting on it internally, externally, just making sure that everyone's aware of what's going on, making sure you've got all those building blocks again, nice and simple. Deciding on the renewable procurement side, do you need REGOs? Yes, no, which is something we didn't talk about. They are optional. And then ultimately, if you do, how many of them do you need? Is it for 100% or not? And then ultimately, do PPAs work well within your business? And then that last bit is just on partnerships, really. It's like what we've talked about here is quite a lot of, tried to simplify as much as possible, but there's a lot of complexity in all of this, and the market's not getting simpler, unfortunately. So what that means is making sure you've got really strong partnerships on hedging strategies, renewable procurements, because they can ultimately have bigger and bigger impact on the actual underlying success of the business, and making sure you're working with the right people and good people on this is important.